Hello everyone. In this particular video, we are going to study about the business trust, the investment fund, and the securitization trust. Firstly, we will study the business trust with an example. There are three people involved in this particular example. Firstly, the unit holders, the business trust, and the special purpose vehicle. Unit holders make investment in the business trust. In turn, the business trust will make investment in the special purpose vehicle. We are going to study the tax implication in terms of interest, the dividend, the rent, and the other incomes. In respect of the income that are being collected by the business trust from the special purpose vehicle, the tax implications are the interest income, the dividend income in respect of which the special purpose vehicle choose to pay the tax under section 115 BBA, the rent income are exempt. So all other income except the above three are taxable in the hands of the business trust. In respect of the long-term capital gain covered under section 112, the tax rates are 20%. In respect of short-term capital gain covered under section 111A, the tax rates are 15%. So all other incomes are taxable at maximum marginal rate. Okay, now let's see the tax implication in respect of the income received by the unit holders from the business trust. The interest income, the dividend income, and the rent income are taxable in the hands of the unit holder since they are exempt in the hands of business trust. And all other income except the above three are exempt in the hands of the unit holders. Once again, we will see the taxability of the dividend income. In respect of the dividend income, where the special purpose vehicle are chosen to pay tax under section 115 BAA, it is taxable in the hands of the unit holders. On the other hand, if it is not covered under section 115 BAA, it is exempt in the hands of the unit holders. Just now we understand the tax implication in respect of the income. Now let's see the tax rates. The tax rate depends on the unit holders being resident and the unit holders being non-resident. So if the unit holder is resident, the interest, the dividend and the rent is taxable at the normal rate. The other incomes are exempt, so there is no tax rate. Now let's see the TDS rate. In respect of all the interest income, dividend and the rent, the business trust is required to deduct TDS at the rate of 10%. Okay, now let's see the tax implication in respect of the unit holder being non-resident. The interest income is taxable at the rate of 5%, the dividend income is taxable at the rate of 10%, and the rent is taxable at the normal rate. The other incomes are exempt in the hands of the unit holder. The TDS rate for the interest is 5%, the dividend is 10%, the tax on rent income is required to be deducted at the rates in force under section 195. Okay guys, now let's see the tax implication in respect of the investment funds. Okay, now let's see the tax implication in the hands of the unit holders and the investment funds. Firstly, we will see the tax implication in the hands of the investment funds. Only the PGBP income after the set-off is taxable in the hands of the investment funds. The tax rates are: if the investment fund is a company, the PGBP income is taxable at the rate of 30%. On the other hand, if the investment fund is not a company, the PGBP income is taxable at maximum marginal rate. Okay, now let's see the tax implication in the hands of the unit holders. All the income except the PGBP income is taxable in the hands of the unit holders. In respect of the losses, it can be carried forward by the unit holders only if the unit holder holds the units for 12 months. On the other hand, if the unit holder not holds the units for 12 months, the losses cannot be carried forward. Okay, now let's see the tax rates in the hands of the unit holders. If the unit holder is being a resident, the incomes are taxable at the normal rate and the TDS rate is 10%. If the unit holder is being non-resident, the incomes are taxable at the normal rate and the TDS is required to be deducted at the rates in force under section 195. Okay, now let us see the tax implication under the securitization trust scenario. Let us see the tax implication in the hands of the unit holders and the securitization trust. Since all the income received by the securitization trust are simply passed through the unit holders, no income is taxable in the hands of the securitization trust. Since nothing is taxable in the hands of the securitization trust, all the incomes that are being received by the unit holders from the securitization trust are taxable in the hands of the unit holders. Let us see the tax and TDS rates in the hands of the unit holders. The income received by the unit holders are taxable at the normal rate. In case of individual or HUF, the TDS is required to be deducted at the rate of 25%. For others, the TDS rate is 30%. Okay, now let us see some of the important points from the exam perspective. If the income is not distributed in case of investment fund and securitization fund, it shall be deemed to be distributed on the last day of the previous year. The investment fund and the business trust are compulsorily required to file the return of income. Okay, now let us see the quick summary of the business trust, the investment fund, and the securitization trust. In case of business trust, the interest, the dividend, and the rent income is taxable in the hands of the unit holders, and all other incomes are taxable in the hands of the business trust. In case of investment fund, only the PGBP income is taxable in the hands of the investment fund. All other incomes are taxable in the hands of the unit holders. Finally, in case of securitization trust, all the incomes are taxable only in the hands of the unit holders and nothing is taxable in the hands of the securitization trust. Okay guys, I will share some of the MCQ questions from the ICSOs at the end of this video. Solve the questions and post your answers in the comment section. I will share the answer in the next video.